All right, so where we stopped on Tuesday was talking about hedging an entire portfolio with derivatives, with options in particular. So this example that we're looking at here, the number of contracts that we needed to hedge a portfolio was related to not only the option delta and the value of the index, but also the portfolio beta and the value of the portfolio. So if I have a portfolio beta, remember that that's simply the weighted sum of the constituent betas. So I can easily calculate a portfolio beta, and depending upon what my portfolio beta is, will tell me whether I need more or less of the index option, because we're assuming we're using something like an S&P 500 index, which has a beta of 1. So if we have a portfolio that is riskier, in other words, is going to move more for a similar move in the market, then we want additional exposure to that index option. If it has a beta less than 1, we want less exposure. And of course, that's also related to the option delta, which is that N of D1, right? In the case of a call, negative N of negative D1 in the case of a put. The other thing to note here that I mentioned on Tuesday as well is that this multiplier in the index option is going to vary from contract to contract. So in any exercises, I would have to give you what that multiplier is. I'm not sure why the authors made that a fixed amount. That's not really a constant. That is just for one particular contract that might have a 100 multiplier. You could have a micro contract where it might be a $2 or a $5 or a $10 multiplier. You could have a big contract, for instance, the S&P 500 large contract on the CME group exchange is $250 times the level of the index. So also recognize that that 100 is not written in stone. That varies with the particular index option that we're using. Here's a little example. Suppose that we have a call option whose N of D1, that is the delta, is 0.579, meaning that for a dollar move in the underlying, the value of the option changes by 57.9 cents. The value of the index is 2046, and so we just plug in that 2046. Again, they're assuming that the multiplier on that particular index contract is 100. Here's my option delta, and then I have a portfolio beta that just happens to be 1, and the value of the portfolio is 10 million. So it shows us that we need 84 contracts in this case, and don't forget that little minus sign out front. So we're going to be short these contracts. We're selling 84 contracts. And of course, in the case of a portfolio manager who is hedging a portfolio, the exchange or the broker on the other side would allow that individual to short those call contracts simply because they know that there is an underlying behind that. So it's not a naked short. Then on to an entirely different subject, and this is really an important subject, and you can do some seriously deep dives into this stuff. Not only this, but even the Greeks. There's first order, second order, third order Greeks. We could spend an entire semester just learning about the Greeks and how they are used in options. However, another important area here is this idea of an implied standard deviation. So if we go back to our formula, and here let's just use this. Yeah, I don't want that one. I want this one. All right, so if we just go back to our formula here, see if I can erase. No, I can't. All right, so we've got the security price, the underlying price, the N of D1, the exercise price, the call, and then D1 is composed of the underlying price, the exercise price, the risk-free rate, the sigma squared, T, and D2 is this. So one of the things that, or in fact, the only thing that we don't easily measure out of this, we can easily observe S, that's in the market. We know what K is, that's written in the contract. We know what the risk-free rate is, that's a treasury bill. We know what the time to expiry is, T. What we don't know necessarily is this sigma squared, or the sigma down here. That's a figure that is really instantaneous volatility. So that sigma squared, if you go back to the theory behind the Black-Scholes option pricing model, is what it gets referred to as an instantaneous volatility. That seems like an oxymoron, right? That's like jumbo shrimp. What's an instantaneous volatility, right? Don't I need some sort of time in order to capture what volatility is? And theory says, no, I need an instantaneous volatility. Well, we don't know how to get that. So what we typically do is we look back historically and we calculate some sort of volatility measure, or at least that's what one would think we would do, and we would use that as a proxy for this unobtainable instantaneous volatility. And then we plug that into our formula, and out pops a call option price, or a put option price, a premium rather, I should say. Now, the problem with that is that that measure that I'm getting is only a proxy for this thing. I don't know whether that's really right. And in fact, if we were to, a corollary or kind of an analogous situation is when we're studying CAPM and trying to determine whether CAPM is the appropriate model that models how stock prices move over time. And the problem is that we don't know what the market portfolio is. Yeah, we use the S&P 500 as a proxy regularly, but that's not actually the market portfolio. The market portfolio is the prices of all assets. And we can't observe some of those. We can't even observe all the prices. So there's this great debate going on. You know, if the S&P 500 is correlated with other proxies for the market portfolio, does that mean that that's correlated with the true market portfolio? And the answer is no. Just because I have a whole bunch of proxies that are highly correlated with one another doesn't mean that they're also correlated with that unknowable market portfolio. The same problem is true here. No matter what I use as a measure of volatility, I'm not truly capturing the volatility that is needed for this model. And that's a problem. So oftentimes what people do is say, well, you know what? Let me assume that the prices, these premiums on the calls and the puts, are efficient somehow. The market determines this, and voila, they're efficient. And then I have a known on the left-hand side. My other factors are known, the S, the K, the T, the R. And so I can actually back into a sigma. And that's what this idea of an implied volatility is I'm using the market prices of the call or the put, that is the premium on the call or the put, and I'm plugging in my S, my K, my T, my R, which I know with certainty, and then I'm backing out this implied volatility, or what the market thinks the instantaneous volatility is. And then I could actually use that to price other options, but it's kind of a chicken and egg thing there at that point, right? And that's one of the weaknesses of this model. As long as we all believe that the prices are efficient in these markets, we're all okay. But the moment somebody comes up with a different model, that could be trouble. Could be one of you. But for the moment, this is the best that we've got. And so far, it seems to give us reasonably good estimates of the value of an option. The other thing, though, that this implied volatility gets used for is to create measures of risk, measures of volatility in the market that are presumably forward-looking to some degree, at least conditioned upon the information that we have available to us at this point in time. So what we could do is we could use that implied volatility out of the S&P 500 index option contracts. And somebody came up with this bright idea of let's use that as a measure of how volatile the market is, and even thinking of it as a fear gauge. I'm not so sure I agree that it's a fear gauge. It's just simply volatility. Let's not attribute any sort of emotional state to the market. Seems a little bit extreme. But you can do that with the S&P 100 and the NASDAQ 100. Now, again, since those indices are somewhat correlated with one another, you would expect the VIX and the VXO and the VXN to be relatively correlated with one another. And obviously, it's the VIX that most people pay a lot of attention to. But that gives us some idea of at least the market's expectation for volatility, conditioned upon the information that we have available to us today. One thing that I would strongly disagree with the authors of the book is that this line right here. VIX is high, it's time to buy. VIX is low, it's time to go. No. I'm sorry. The VIX is still not necessarily what's going to happen in the future, right? What's going to change the VIX? New information. Do you have a crystal ball? If you do, text me. We can talk. Right? So, yeah, please ignore that. That's just more technical trading rules that really, for the most part, don't work and can actually possibly get you into deep, deep trouble. Okay, so that's questions on implied volatility or on coming up with a hedge portfolio or a hedge for a portfolio. Pretty straightforward stuff. Okay. Now, the last part of this chapter talks about employee stock options, and the authors suggest that this is important because many of you hopefully will have some of these as part of your compensation package, which I hope that is the case. So these employee stock options are typically call options, and they're granted, in other words, given to employees of a company. And usually we're talking about C-suite, right? CEO, CFO, COO, those folks are typically getting these as part of their compensation package. Now, that's not to say that even there may be other companies. In fact, there are companies that will give many other employees stock options. In fact, especially if you're dealing with, say, a startup, that's one way of attracting talent that you might not otherwise be able to afford if you were simply paying a cash salary. Now, you can't avoid paying some sort of cash salary, right? Because people have to pay rent and electric bills and taxes, property taxes, that sort of thing. But this can create that additional sweetener that might encourage somebody who is otherwise indifferent to move from their current company to a startup and see how things go. It's sort of a gamble. How do these things work? They work just like a regular option with a few key differences relative to the standard exchange traded options. They have very long lives. Their time to expiry can be up to 10 years. They cannot be bought and sold. You can't trade these things. And that presents a serious problem, right? Because, we've already talked about the fact that an option is worth more alive than dead. Well, in this case, the option is worth what it's worth, dead, period, because you can't sell it and capture that time value component of the premium. All you can do is exercise it and capture the intrinsic value. So the moment it goes out of the money, it's totally worthless to you. So unlike an exchange-traded option that's out of the money, or at least just slightly out of the money, if it's deeply out of the money, it's worthless as well. But a little bit out of the money, and there's still that time value component that has brings value to the option itself. There's also a vesting period, typically 3 years. I've seen them shorter than that, but it's not uncommon to have a 2-year vesting period as well. And these vesting periods are the time by which, if an employee leaves the firm prior to vesting, they lose the option. They lose the right to that option or that grant of options. So these things are relatively difficult to value because, hey, I can't trade the thing. They have these very long lives. And the other thing to know, once they're vested, for the most part, empirical evidence suggests that upon vesting, employees exercise their options if they're in the money. And there are even some tax details that might cause differential execution or exercising on these options. So these things are difficult to deal with to some degree. They certainly create incentive for the employee to try to run up the stock price. They help align the employees' incentives with those of the owners. And remember, we've got this idea of agency theory, which underlies a lot of the work that we do in finance. And in agency theory, we have an agent and we have a principal. And the agent is working for the principal. And ideally, the incentives of the agent making decisions are identical to those of the principal. But of course, we're human beings, and we're trying to minimize our expense, maximize our utility function. And so I may do something as a manager that would be suboptimal to the owners. Or I may, and it could be an act of omission or an act of commission. So I might actually engage in an activity that brings some utility to me at the expense of the owners. So that's the commission piece. Or I might not take on a riskier investment of some sort because if the company goes into bankruptcy, I lose my job. I might not be able to find another one. Whereas that actually could have been beneficial to the owners that I undertook that highly risky project. So I could have either commission or omission, and I want to avoid as much of that as possible. So I use these stock options. Why options rather than stock grants? Well, the answer is simple, is that there's much more leverage under these stock options, right? In fact, most compensation packages of S&P 500 type companies include a little of both. And then there are some more recent trends towards even longer term contracts that hopefully better align employee, CEOs, COOs, CFOs with those of the principal, the owners of the company, rather than trying to make quarterly numbers so that I can exercise my options. Okay. One thing, and we've got a couple of things in this chapter where I disagree with the authors. No upfront costs. No, untrue. Completely false. ESOs are not without upfront costs. What are those upfront costs? Any ideas from those of you in the class? I mean, they're just a piece of paper, right? What would the upfront cost be? What happens when these options are exercised? Where do the shares come from? Everybody's so quiet. It's that rainy day, right? Where do I get those shares? Where do you where? Oh, go ahead, Spencer.
Is it the company you get them from?
Yeah, we're actually issuing new shares. In fact, interesting little sidebar here. The whole way that stock repurchases came into being was because of these employee stock options. So if I were not to have a repurchase program, I could severely dilute my shares outstanding, right? So if you were an owner and I'm issuing all of these stock options to employees, that's increasing the shares outstanding. And if I didn't have a repurchase program to buy back some of those shares, I could dilute away an owner's stake in the firm, a percentage stake in the firm. So that was one of the initial requirements of these ESOs, was that at the same time a firm starts an ESO plan, that they also start a repurchase plan so that they can manage that dilution and erase it, right? So if I've got 1 million shares outstanding and I grant 100,000 shares worth of stock options to my employees, that could dilute the existing owners by 10%. Well, if I buy back those 100 shares over that intervening year, then I remove that dilution effect. Now, obviously, repurchases have come to be used for many other things instead as an alternative to dividends, and that's a whole different discussion that you get into in 440. But yeah, so these options do have a cost. Now, maybe the qualifier upfront cost. Okay. Yeah, does the firm actually pay anything immediately? No, but there is a cost to it, and that cost is dilution. And I'll have to actually have some cash on hand to go out and repurchase those shares to prevent that dilution from occurring. So ESOs can be viewed as a substitute for ordinary wages. Well, to some degree, right? Like I said earlier, you still need some cash, obviously, for the executive to pay rent and buy food and those kinds of minor details. ESOs are typically issued at the money. So they have an intrinsic value of 0. So, and again, this dates back to something that has been abolished back in the early 2000s. It used to be if you issued a employee stock option at the money, then you did not have to expense it on the income statement. So you could avoid reporting it. So it could look like you had less expenses, when indeed you still had the expenses, because at some point in the future, if those things get exercised, not only are you potentially diluting, but you're selling those shares for cheaper than the market price of those shares. So there's a direct cost to shareholders. So that rule was changed back in early 2000s. And actually, there was a transitional period where you could choose to expense it or not. Some firms did. And then I forget what the day, it was something like 2001. All firms had to expense those on the income statement, even if they were issued at the money. And they expensed them at fair market value using Black-Scholes option pricing model to come up with what that fair value was. So what we find is that pattern, though, still exists, that these ESOs are granted at the money. So by granting at the money on the day of issue, K is set equal to S for that particular day, the closing price. So if I grant them today, I would look at the closing price today for that stock, and I would set the exercise price to that particular price. Now, the problem with this is that if the price drops, then all of a sudden the intrinsic value of these things, actually, if we were to do the S minus K, it actually becomes negative. But of course, the executive would just not exercise it. Well, if the price continues to drop over time, what that does to the executive is that they basically say, hey, these things are not only virtually, they are worthless. So why should I, work any harder for the owners? I've got a bunch of worthless contracts here. I can't even sell them. I can't even get a time value component out of it. And that's a real problem. That problem has been circumvented to some degree by this idea of repricing. So let's say I granted some stock options a year ago that vest in 2 years, and those particular options were granted at the money on the day of the grant. And as a result, stock prices have dropped since then. And as a result, those options are underwater, or in other words, their intrinsic value is zero. So let me change the exercise price downward on those options. So I'm repricing them. I'm creating new options that are now at the money at this lower K. Now, one could say, well, doesn't that sort of remove the incentive of these things? That, if the stock goes up, you make money. If the stock goes down, you reprice the options. Well, yeah, that's a problem. The counter problem, though, is that if you don't reprice these options and the executive's compensation is based upon these things, they leave. Well, maybe you want them to leave because they haven't been driving the stock price up, too. So it's a little bit of a mixed bag here. Many firms do this repricing. You'll see this quite commonly. And you run into the same sort of problem when you're dealing with hedge funds or private equity firms. The performance piece, there's usually a high water mark. And if the value of the fund drops below that high water mark, the managers of that fund no longer get a performance bump until they exceed that high water mark. And if you're way below the high water mark, management says, hey, nothing to lose. I'm leaving, hitting the road, restarting it. I can restart that at a new company. So this sort of problem exists in multiple venues. So repricing is here with it. It's here to stay, I'm pretty sure. It is not the best of all worlds, but it's certainly a workaround. Another way to avoid this, though, is to continue to issue new options at the money. And hopefully at some point that keeps the executive around and keeps rewarding them for good behavior, driving the stock price up. But I mean, it's also a problem that some of these things are market-wide driven, right? How can I control a pandemic? And that's a justification for this repricing, is that, hey, there are certain things out of the control of the management team that are market-wide or systemic. And so as a result, yeah, repricing is reasonable in many cases, as long as it's not just a given that I'm going to reprice these. If I can see that, hey, everybody else's stock is up, but our stock is down, I might want to get rid of those executives to begin with and forget about repricing at the moment. One other thing, this wasn't mentioned in your book, but this was a massive scandal back in the early 2000s. Eric Lee published a paper back in 2005, and really it was the culmination of a kind of a small series of papers that led up to Eric's paper. But it was about the timing of CEO stock option awards and this idea of backdating. So backdating is when a company says, we're going to issue stock options to our executives. And the board of directors approves that grant, but they don't set a particular date. And then we let some time go by, and then we look back over the price series, and we find a low point in that price series, and we say, that's the day of the grant. I'm going to set my K equal to my S on that day, and prices have gone up since then. So now I've got some sort of already embedded gain on that particular option. They're already in the money. That's backdating. So I look back on the price rather than grant it today and just let the price be the price. I'm actually looking back, so I know for sure that these things are in the money. even though I still granted them at the money of the price on that particular day. So what Eric did was he looked at over 2,000 firms between 96 and 2002, and he looked at 30 days either side of the option grant, the actual grant date, the date that the company said, this is the day we grant them. And he found a negative 3% abnormal return. Remember what an abnormal return is. It's the return we observe minus the return we would expect to get, and that's using either CAPM or a FAMA French 3-factor model or something of that nature. Carhart 4-factor, something like that, usually multiple of those. But he found a negative 3% over 1 month, right? Actually, I believe it was 30 trading days, so that's 1.5 months in calendar time. And then he looked 30 days after the grants, and he found a 3% positive abnormal return on those days. And, he looked at this data and said, hey, something's up. Either executives and boards are just really knocking it out of the park in terms of incentives, or somebody's looking back. In fact, if the picture worth 1,000 words, this is the picture that created the biggest stir about this backdating. Look at that. This is the date of the grant. And don't worry about scheduled, unscheduled, unclassified. Unclassified is just simply he couldn't tell whether they were scheduled or unscheduled. Not a big deal. Fairly small part of the sample. Scheduled simply means that those options had been granted within a week of the last grant from the prior year. All right. But we see the pattern still in the scheduled guys are this line right here. We see a stronger pattern in unscheduled ones. So if they get to pick the time, that's when we get this 3% decline followed by a 3% increase. And it just is so perfect that you can't help but think that there's something going on. And so this was proof positive that there was backdating. Now, the next question that comes up, is backdating illegal? And the answer is not always. In fact, as long as the company reveals that this is what they're doing, then it is perfectly legal. Is it ethical? Is it good for aligning incentives? That's an entirely different question, and one open to various interpretations. Now, it is, however, illegal, and Eric Lee made quite a bit of money consulting and doing expert witness in court cases. It is illegal if the firm does not reveal that this is what they're doing. So this is kind of a proof that footnotes in financial statements do matter. You would figure this out by reading footnotes. You wouldn't see it anywhere else. But this backdating scandal made quite a splash back in the early 2000s and did away with most of it. For the most part, companies don't do any sort of backdating anymore. But I just thought I'd bring that to your attention as well, because many of these things get revealed by academic research. And this is a fantastic example of that. Eric Lee's research was really the article that drove all of this scandal and made it front page headlines in the Wall Street Journal. ESOs today, typically, like I said earlier, they're still granted at the money. They can be quarterly or annually. And you'll see these things showing up in Edgar, right? You look at the forms 3, 4, and 5 on Edgar if you want to see what these option grants look like. You can certainly look at the proxy statements as well. That's where you're going to see executive compensation in its entirety. So you'll see not only the cash, the bonuses, stock grants, option grants, the whole 9 yards, any sort of long-term features or any sort of long-term contracts that they have as side agreements as well. And that's pretty much it. They do add in here that Many of these firms are dividend-granting firms, and as a result, we have to do a slight adjustment to the Black-Scholes model. And this is actually attributed to some work that Merton did, Bob Merton, with Fisher Black and Myron Shoals. And that is to add in this Y, which is, and sometimes you'll see it notated as Q, just different notation, but the Y captures the dividend element of this. Because, right, when you pay out a dividend, what do you do to stock price? Stock price goes down. And so you want to adjust for that. If you've got a known dividend that gets paid out by the firm, you're going to adjust the value of your option, the premium, by the amount of the dividend. So you'll see it showing up here as a discount factor. And I think that's pretty much it. Actually, one other thing I did want to point out to you is that coming up with fair value. I mentioned earlier that usually these things get exercised the moment they are vested or very shortly thereafter. And so as a result, if I value it to maturity, I get a different number. For instance, in this particular example, we've got a time in years to maturity of 15 years, but they're vested in 6 years. And you'll notice that there's a significant difference in value. Now, granted, here's the problem, right? This premium still takes into account the time value component, and executives can't actually capture that. But other than that, I think that's all I wanted to share with you out of that chapter. Questions, comments?